All right, guys, our next, it's not really an indicator, but it's something that specifically for our strategy is going to be used significantly. And that's called the market gap. Now, it's exactly what it says. It's when the market forms a gap in its price movement. So if we look at this chart, it's the 5-minute ALSI. There it formed a gap. That was the previous day, and that was the opening of the next day. Here's another gap. Here's a huge gap, another gap. And as you scroll through ALSI on 5 minutes, you'll see massive amounts of gaps. Okay, here's another gap, gap, and it's just, and all of them was on the opening of the day. Now, what is a gap? A gap is very simple. It's when the price movement from one time frame to the next interval of that time frame, and the opening, the opening or closing price is lower or bigger, or bigger or smaller than the opening or closing price of the previous session. So here we had opening, closing price on that last session. Ignore that little green line it's forming there. It's GT2047. At the end of the day, they make a little thing like that. I don't know why. And then the next day, the next session opened here. So the opening price was lower than the opening price of the previous day. Hence, there's a gap. There's nothing in between, empty space. The market never traded there. It closed there the previous day, opened there the next day. So there's a gap. All right. Here it went the other way around. So market closed here the previous day, opened there the next day on the open of the market. Gap. So the price jumped from 51,699 to 51,848. Okay, that's the jump of the market. So it jumped, closed there, next day the price jumped up. So the question is, why does the market do that? Well, first of all, on ALSI, we always see it in the beginning of the day, but in Forex and other trading platforms, depending on volatility, specifically when there's volatility involved, you might even see it in the mid-range of a price movement. So anywhere in the price movement, you might see it gapping. In ALSI specifically, the reason is the following. Our markets close at 5:30 in the afternoon. Our stock exchange locks up. Guys take their bags and go home to get tickets. But the American markets only open at 3:30 in our afternoon. That's when the S&P and the Dow Jones and the American markets open. So our markets, a lot of our instruments is listed overseas. For instance, your Naspers, your gold mines, etc., are listed. So although our market closes locally, our brokers go home. Work is finished, and some of our instruments, like the ALSI, will shut down at the end of the day. No more candles because our market closed. A lot of our other elements, trades on other markets, or can be traded on other markets overseas, or are connected to other companies that are being traded on the overseas markets, like the European markets and the American markets. And then obviously in the morning session, the Chinese and the Far East, Australia and China, Japan, they pick it up. So a lot of things happens between the point that our market closes down and that market opens up again. Okay. In this period, for instance, overnight something could happen and the price of gold is just skyrocketed and exceeds, which will then increase the price point of our gold mine shares. And the ALSI, remember, is an index. It's an index that reflects the top 100 performing listed companies on the JSE. So for instance, if a Naspers moves massively, or if a gold sector moves massively, or banking or what have you, then that's what affects these candles. So if something happens overnight while our market is closed, either our companies that's listed overseas are being traded and the price is being driven significantly, or some fundamental shift in the markets overnight, then the next morning when we open, the price is different than the previous day when it closes. And when it gaps, that's when the price is significantly different. It doesn't always gap, but the Aussie gaps a lot. All right, so that's the gap. How do we measure the size of the gap? Click on that little arrow there. You just go to the bottom and you drag till it's there, and then we see, okay, that's a 127-point gap. Markets have gapped down 127 points. And that's a gap. The interesting about gaps is there's a lot of strategies around gap. It's the saying amongst traders always is a gap always gets filled. Okay, so I would go to my daily and I will mark gaps very clearly. So if you look here, actually let me open this chart, because these little arrows you see here, those are faulty arrows. Ooh, candles. Still gotta get. Okay, this is monthly. We're gonna go to daily. Let's just remove some of all of these things so it's a little bit more clear for you. Let's remove the total offsets. Okay, just clean it all up a little bit. Let me just remove the Bollinger as well, so we have a nice clean market. So here you can see this is the Aussie daily chart over a much longer period. So there was a gap, but that gap was made, it was closed. See, so it was a gap, market went down, but market came up, closed the gap. There was a gap, market went up, there was a gap, closed the gap. So gap always gets closed. So typically the Japanese traders of back in the day, before the Western world, they were fixated about gaps, and apparently a lot of them were like staring at charts, just marking gaps and then trading towards those gaps. Because why? Because of the theory that the gap always gets closed over time. So it's a very strong support resistance line, the gap. So market will very much come down to a gap and then bounce off it, or vice versa. So we're going to use the gap in our 5-minute strategy. More than that, it's not really important, besides the fact that we can use a gap as a support level, and as we trade, we will talk a little bit more about that. For now, you just need to understand what a gap is. It's where the market price opens higher or lower than the previous day's close open, and therefore opens up the market for a space where there are no price movement, and that's called the gap.